What's up, audit fans? Dr. Amanda White here, and I'm back today looking at ASA720. This is one that people have been asking for a while, and I thought, okay, let's just get it done. So let's get into it. And welcome to Amanda Loves to Audit. For those people who are new, welcome. My name is Amanda. I do love to audit, and I teach audit to undergrads at a major Australian university. Now, today we're looking at 720. And if you think about sort of the audit report and the annual report and how it all fits together, we have our annual report. Management put together the annual report. A very small section inside the annual report contains the financial statements. And of course, inside the financial statements is our audit report. So today, what we're going to be looking at is what happens with all the other information. We audit what's in here in the financial statements, but what do we need to do about all of this? Let's skip ahead to the actual standard requirements. Now, of course, for those people who are studying internationally, this complies with the ISAs. So you'll also find a little statement in our Australian standards that it's conforming with ISA 720. There's just a few areas where we have some specific Australian requirements related to our laws and a few other things. So if you're studying the international standards, this video should be suitable for you as well. So when we talk about the scope is what does the standard cover? So it relates to information, whether financial or non-financial, in the entity's annual report. Remember, the annual report contains a lot of glossy pictures, it contains reports, it contains diagrams about the business and what it's been doing over the year. It could be one document, and most of the time here in Australia, we do see an annual report that's a single document. There could be environmental or ESG reporting, climate or carbon-related reporting, social and governance-related reporting. So there could be many things all in the same document. So it says here, our standard is written in the context of an audit of a financial report by an independent auditor. So this is really audits of proper audits. So this is not for internal auditors where we're thinking about audit from a different perspective, and it's audits conducted in conjunction with ASA200 or ISA200. Let's get into the objectives. The objectives are really the key points of the standard. So the objectives of the auditor, having read the other information, all that other information that's in the annual report, I'm looking for a few different things. I'm looking for material inconsistencies. A management saying that the company is doing well when instead the company has been making multiple losses. So that's an inconsistency. Whether there is an inconsistency between information and our knowledge from the audit. So this first one is about other information presented in the report. But what if there is other information that is different to what we know about the company? So it sort of takes into account things that we know that might also not be reported by management. And so then the next part is the so what, part C. We have to, and it says very clearly here, respond appropriately. So what does that mean when we say respond? That typically means that we're going to need to tell somebody about these inconsistencies, because surely shareholders would want to know when the financial statements paint one picture of the firm and then the rest of the annual report is telling somebody something else. Now, why is this important? This is really important because annual reports are long. Accounting nerds like us probably will be like, oh, I'm not going to read the glossy stuff at the front. I'm just going to flip right through to the financial statements and the auditor's report. But most shareholders are going to get fatigue. The average shareholder is going to get fatigue looking at that information. And so instead, they're going to look at the front and they might not make it too far or get into too much detail. Now, if they happen to look at the auditor's report, this is our chance to sort of wave our hand and point a big finger and say, you should probably look at this because this is not telling the same story. The financials are telling a different story than what management are saying. Now, there's some definitions here. They talk about what an annual report is. We know about that. And then they talk about misstatement of other information. So what does that mean? It's when other information exists, when that is incorrectly stated or otherwise misleading. So incorrectly stated, that's just stuff that's blatantly wrong. But otherwise misleading might be, well, it could sort of be the truth, but still might be misleading because it omits or obscures information that might be necessary to have a proper understanding. So it sort of might be half of the truth. We might have some fancy words that maybe are trying to bamboozle people. So there could be a couple of different options where we can have incorrect or misstatement in other information. Now, up here it said misstatement of other information, but what exactly is the other information? Well, that's where we go down here to part C, where it says it's financial or non-financial information other than the financial report and the auditor's report included in the annual report. And remember, that annual report could be broken up into multiple different documents. It doesn't necessarily have to be the same document. So it's anything else in that glossy brochure or that really long PDF. And if you notice, a lot of annual reports are hundreds of pages long. So there's quite a lot of information in there for auditors to look at and compare to what the financial statements are telling you. So the bits that are really important for us here in Australia is the requirements. Remember, the requirements are the parts that are legally enforceable. All the stuff back here is just context and information. This is the what auditors must do. So these are the rules that we have to follow and that we're expected to do. So it says here, the auditor shall, instructions to us, determine through discussions with management which documents go into the annual report. So this is where I need to know what's going into the report so that I know what documents I'm going to need to look at. And I want to know the manner and timing of these documents so that I can plan enough time. I need to plan time to review this and check that it doesn't, conflict with information that we have in the annual report. So knowing about the timing is really important to allow us to make sure there's time within our budget. Now, it says here in the second one, obtain these documents in a timely manner and the final version. So we have to be careful, it's the last version. We don't want an interim version where we might say, yep, that's fine, but it might end up being not the correct information in the end. It might be outdated in some way. So we need to make sure we're looking at the final documents. And here's one, really important. What happens if some of the documents are not available until after? So not available until after the date of the auditor's report. Then I have a very specific instruction. Request management to provide a written representation that the final documents will be provided to the auditor when available and prior to issuance of the entity. So that means really it's Monday, we're signing our audit report, the financial report, and the annual report is going out on Friday. We are saying to management, you are going to give us the final copy before Friday. All right? Then we are still going to follow our requirements, our instructions in accordance with ASA720. And remember, if we find something, we may have to potentially change our audit opinion. So there's a little bit of time here to check and potentially change our opinion if we look at these final documents and things are really different. Now, you could sort of get away with this by looking at interim or draft versions, but then you need to make sure that what you see in the final is pretty similar to what was in the draft. So now we have to look at reading and considering the other information. So this is, again, more instructions to us, and it says, I should read the other information. So that's the first bit, read the other information. That bit isn't that tricky, but it's something very clearly is stated for us to do. So I have to read the information and I have to say to myself, is there a material inconsistency? So every time I'm looking at each of these pages, I look at it and say, does this make sense? And this is where that mental model approach to auditing of knowing your client, knowing how everything fits together, and not just rote ticking and following the instructions in the audit program without understanding what's happening and knowing your client. This is why 315 and that approach of knowing the client, mental modeling, putting it all together, knowing what to expect, comparing what you see to what you expect is really important. Because when you get to this part and you need to look at the other information, you need to slot that in with everything you know about the company. Does this support what's in the financial statements? Does it contradict? Does it tell a different story? So I have to evaluate consistency, compare selected amounts or other information. So if they say, there's graphs or diagrams with numbers, you need to check those to the annual report or the financial statements to make sure they're correct, so that there's nothing misleading. So we're checking the numbers as well as that the story is really consistent, because we're also making sure story is consistent. All right. Now remember back up here in the requirements, where it says, hang on, where is it? Back in the objective, sorry. The objective said I have to make sure that is there any material inconsistency between the other information and the financial report? That's part A. 11B says, are there any consistencies between other information and what we know about the company? And that's stuff that's not necessarily printed in the financial statements. So all of this here is related to 11A, all right? This one here is related to 11B in terms of the objectives. So I have to look at that other information and say, okay, well, is it saying the same thing as the financial statements? And then I have to say, well, does it fit in with everything I know about the client, everything I've learned, and maybe things that are not published anywhere else? So this really is quite a difficult job, and it requires you to know a lot about your client. Now, this is not something you'd be doing as a graduate. This is something that you'd be doing at a higher level. Now, let's look at paragraph 15. While reading the other information, I shall remain alert for indications that the other information might be materially misstated. There's a bit of a page break there. So I should be alert for indications that something is not really what it seems. Okay, so, we're using our red flags. We might just say, look, does this seem consistent? And sometimes you might say, look, I've got a gut feel that something does not quite add up. And sometimes that gut feel might actually be your subconscious acting like a really human supercomputer, putting together links to different things that you might not explicitly be able to understand or explain or put out and describe, but your brain is saying there's a connection here. So I have to be alert. So what do I do? So this is if we find material inconsistencies, which I'm going to label as MI. So if we find an MI, then we need to go here into paragraph 16. If I identify something, I shall discuss the matter with management. So that's really easy. I go up to them and I have a chat. Now, not you, the audit junior, but certainly this would be something that the manager, the director, or the partner might take up. So we're going to have a discussion with them and potentially perform other procedures. So that might mean that we have to dig into a bit deeper the other information, ask for clarification, potentially interview people, or look at more evidence. Now, it says here, I have to make a conclusion. So when I say conclusion, I really have to make a decision. And a decision means it's going to be one of these three items. Is there a material misstatement of other information? Or if the other information is correct, then does that mean there's an error in the financial report? All right. So this is saying, actually, the other information is correct. The financial statements are wrong, and we've maybe missed something. So this option here, we would need to do more audit work to investigate and say, oh, well, if the other information is correct, we could be wrong. We might not have found an error. Or potentially, the auditor's understanding of the entity and its environment needs to be updated. So it might be that I don't know enough about the client. Something might have changed in the environment, which means that the other information might be correct, And remember, this one is not necessarily related to what's in the financial information, but it's related to other information that might conflict with our understanding. So I have to make a decision, and it has to be one of these three. I say, yep, there's a misstatement in the other information, or, ooh, no other information is correct, but we might be wrong in checking the audit. So maybe there's still a financial statement error, or maybe I don't understand the client well enough. So those are the three options. Now, what happens if I go through all of this process up here and I decide that it's A? If I decide that it's A, then we flow down here into this section about responding when the auditor concludes that a material misstatement other than information of the other information exists. So we're saying like, yes, it's not that we made a mistake, it's not that we don't have an understanding, it's that there really is a misstatement. So if I make that conclusion, and remember this one comes from 16A up there, then I have to go talk with management. Remember, I'm talking with them about this whole process. And I say to the manager, correct the other information, please. Please make a correction. Now, if management says, yep, we're going to agree. So really, they're giving you the big tick and they're saying, yeah, I'm going to make the adjustment. Then I say, that's fine. I don't need to do anything else. It's like correcting a misstatement. As long as the client corrects a misstatement, we don't need to modify the opinion. So here we're saying, yep, you did it, tick. Onto an unmodified opinion we go. Now, B is where the client goes, I'm not willing to make the adjustment in the other information. Then I have to communicate with those charged with governance and request that a correction be made. So I go to the board, or I go to the audit committee and say, look, can you make the correction? Now, here's where it gets complicated. What if the information is not corrected? All right, so here it says, if the other information is not corrected after we communicate with those charged with governance, I have to take action. So it says here, consider the implications for the audit report and communicating with those charged with governance, which really means basically we need to go into ASA720 and consider other matter paragraph. All right, so that's what A is sort of alluding to. It doesn't say it very clearly there, but it says, well, essentially now we have a potential, we have this misstatement in other information, and then I go into ASA 706. The other option, which is probably a little bit late to do, withdraw from the engagement. It's pretty hard to withdraw from the engagement when you're pretty much at the end and the other information conflicts. So B is very unlikely in this instance. Now, part of this, and 18 and 19 are about dates, okay? And there are some important dates here. So in 18A, it says, oh, hang on, it's 18, sorry, in itself. If this is done prior to the date of the audit report, all right, so prior to the date I sign, then if management are saying, I refuse to change the other information, I think about adding the other matter paragraph to my audit report. Now, the difference is that in 19, it says if I make that conclusion after I've signed the audit report. So I find that there's this misstatement with other information, and the key here is after, then I have a different set of requirements, because then I have to go to management and say, look, I think there's an issue. I might need to do some procedures. So it says do the procedures necessary. So really, they're just saying here, just investigate to make sure that you're sure that there's an inconsistency. And then you go to management and you talk to them. So I go and communicate with those charged with governance. And if it is not corrected, they don't make the change, then I have to take action. So here it says very clearly, take appropriate action considering our legal rights and obligations. Seek to have the uncorrected misstatement appropriately brought to the attention of users for the financial statement. So what does that mean? Just like, I guess, sometimes with subsequent events, we might discover that there's an issue, management don't want to make an adjustment. Here, you're probably going to need to go to ASIC. All right, you've already gone to the board. The board are like, nah, not going to change anything. We're happy with how the other information is. Then you need to go to ASIC and make a report. And you potentially have to consider how you're going to prevent reliance. All right, because the management already have your audit report and it's going out there in the public. So realistically, you don't want to be in this paragraph 19 situation. You want to try and make sure that you review all of your other information before you sign the audit report. All right, just say, look, I'm not willing to sign until you've given me that information. I don't want to look at drafts and then potentially have the client change stuff and then they refuse to change and they've already got your audit opinion and your audit report. Then you have to prevent reliance, and that's a whole lot of other issues. Obviously going to ASIC is one. Potentially you might need to make a market announcement. So you go to regulators, you go to the market, and depending on how big the company is, options could include taking out an advertisement in the financial newspaper of your jurisdiction. Now, when it comes to paragraph 20, this is where it gets a little bit complicated. Remember back up here in paragraph 16 where if there is a material misstatement of other information, then I have to request changes and go through this whole process in 17, 18, and 19. Well, if there is an error in the financial report, and I'm like, oh shit, the other information was correct, the financial report is incorrect, or if I don't understand the client correctly, then that's when I go down to paragraph 20. So it's sort of 16, B, and C. Let me write that down here. So paragraph 16, B and C result in this option here. All right. So what happens if I find that, oh crap, there is a material misstatement in the financial report, hasn't been adjusted? Or if I don't understand the entity really well, then it just says, follow the other standards, which really means that if there's a material misstatement in the financial report, you ask management to make an adjustment, and then whether they adjust or not will flow in and affect your audit opinion based on, oops, I just realized I can't see with my head there, 700 and 705, okay? If I haven't understood the entity, well, then I need to update my understanding under 315, okay? So those are sort of the requirements. All right, so now we've done all the legwork and we need to get into the reporting. And the reporting is really, how do we present this? So we need to present the info to shareholders. Whoops, to shareholders. Okay, now it says that every audit report shall have a separate section that says other information. And what we do is we say, look, we got the other information. So we have obtained the other information. Then we have to sort of give our opinion on that other information. So I've got my other information. I have some fairly basic stuff. Management is responsible for the other information. It's not the auditor. The other information we got by the appropriate date. And here is probably the key part here. A statement that the opinion does not cover the other information. All right, so I'm not giving reasonable assurance about the other information, but an E is probably where it really gets a bit juicy. I say, I have nothing to report. Like, I've looked at the other information, it's all fine. Or where it's problematic, I say, there's an uncorrected misstatement of the other information. And then I describe it. So in this particular instance, I'm saying, yes, the other information is inconsistent. All right. So here I am saying there is inconsistent other info. And then I go to tell users of the audit report about what it is, because I describe it. Okay. Now, 23 says when the auditor expresses a qualified or adverse opinion, the auditor shall consider the implications of the matter giving rise to the modification. So that basically means that I do my other information sort of section about whether there's inconsistencies or not inconsistencies, but that really doesn't have anything to do with the qualified or adverse bit. I can still give a qualified or adverse opinion, and I have all the information about qualified or adverse. Obviously, there's some reporting in the law there, and that we always have to, and I always tell you about this, we have to document everything in case we have a legal issue or in case we get a regulator inspection, or it could be a chartered accountant's inspection, or it could even be a within firm audit quality inspection. All right, we need to be able to justify why we've made decisions. If we've identified potential inconsistencies, but then we decided they weren't, we should have clear expectations to document why we made those decisions. Because remember, I can't remember what I had for lunch last week, let alone what I did on an audit 5 years ago when there might be an issue. Now, of course, after this, there are pages and pages and pages, another 30 pages of explanatory material that you can go and read at your leisure in accordance with the cross-references. So for example, up here in paragraph 20, this bit here where there's a little cross-reference says, oh, well, look, there's extra information. And you can go and read those extras. If looking at the standard and watching this video doesn't quite give you enough information, always go into the explanatory material. So that concludes our little video there on ASA720. I hope that was useful. Of course, if you have any questions, drop them in the comments. I hope everybody is staying safe, they're staying well, and I'll see you next time.